Hey, the Guaranteed Retirement Guy here. So I get this question a lot. Are annuities risky? Well, are they? Here's the thing with annuities. When you buy an annuity, you're looking to remove risk, not increase your risk. So let's talk about risk. Let's say I'm getting close to retirement and I've got all of my money in either stocks or mutual funds. Maybe I have it in, maybe real estate. Have you ever had a rental property where the renters destroy it? I've had one like that, and it can be very frustrating. So there's lots of ways to produce income for yourself during retirement, but there's also risk associated with it. So when I get the question, are annuities risky? That can be subjective. So I like to compare really risks that you could take versus having an annuity contract that is really supposed to shield you from all types of risk. So, all right, so let's talk about it. So we've got stocks, we got bonds, we got mutual funds. You might have money in a business. Maybe you have money in real estate. There's lots of different things that you can do as far as generating income, but they all have a level of risk. Now, when people talk to me about annuities, they ask, are annuities risky? Generally, the answer is no, because annuities are there to take away risk. It's a contract with an insurance company, typically a life insurance company that sells life insurance and also sells annuities. And a lot of times we're looking at A-rated carriers that have been around for a long time, that have a large amount of capital and also a large reserve. And just by that alone, just having a large reserve and having an A-rated status, typically you are taking away your risk. Now, guarantees are only as good as the backing company, right? So with insurance companies, you're looking at companies that are the strongest companies out there. There's some decent B++ companies out there, but most of the time my clients would like to stay in the A-rated range. But there are some decent B++ for sure. But if you're looking at protection, you probably don't want to go much lower than that. So if you're looking at maybe some C-rated or maybe even a company that's not rated at all, they're kind of new and they're offering these nice rates. I usually tend to steer clear of those if I'm looking for guarantees and I'm looking to mitigate the risk that are in my clients' lives. So if you're at retirement, you're close to retirement, and you want to get rid of risk, then an annuity is one of the safest ways to grow your income. It's one of the safest ways to grow your wealth and protect it against any type of market risk, business ownership risk, real estate ownership risk. And it may not earn as much as maybe some of those other tools or those other investments that you can put your money in. But it's not designed to earn you a ton of money. It's designed to give you either a huge income payout, if it's an index annuity with an income rider. Those typically are really, really good for income. Or if you're just looking for maybe an accumulation annuity, maybe with a fixed rate, 5 or 6% guaranteed, or maybe something just tied to an index that has maybe a high participation rate and you want to take advantage of the index growth, then those are great. All of these annuities protect against market risk. So if the market does go down, then your principal stays the same. It's not going to go down. In fact, if you earn, let's say 10% in a year, and maybe you got $500,000 and now it's $550,000 up here, and now you have a down market where maybe a traditional account, it will wipe out all of your earnings and maybe even some principal. With a fixed index annuity, it's just going to stay right there. Okay, it's going to keep that $550,000 and it'll just wait for the next upswing. So that's kind of the beauty for these index annuities. Now, again, they may not earn as much. So sometimes we think about opportunity costs, or maybe an opportunity cost could be classified as risk. Well, I suppose, the market might go up 10, 12%, and maybe your index annuity will only give you 8 or 9. That's not always the case, but a lot of them might not give you as much as maybe the raw stock market would. But on the flip side, when the market is down, they're not letting you participate in any of those downsides either. So if you have a significant downside or even a market crash, you can sleep well at night, and you can have that peace of mind knowing that your money, your account balance, is not going to be hit. So when you're at retirement or you're close to retirement, those are things to think about. So as far as taking risk away from my clients, I think index annuities are some of the safest investment vehicles out there to do that. I mean, you have a company that is more regulated than a bank because they have higher reserve amounts, much, much higher than a bank's 10%. And they're not trying to be a hedge fund. They're not trying to make these crazy returns. Okay, they're typically putting their money, if they want an index growth, they're buying call options associated with an index. So if it's an S&P index, they might buy a bunch of call options at a discounted rate and then exercise that later on if the index experiences growth. And that's how they're able to make some money, able to make you some money. And of course, if the market takes a nosedive, well, you just don't exercise those option contracts and you don't lose a dime. So that is what these insurance companies are doing. And on top of that, they're state insured. Okay, so if something were to happen and a company were to go bankrupt, then the State Guarantee Association will step in. And if that's not enough, then you would typically have reinsurance offered by other insurance companies that offer several layers of extra protection in case a company goes out of business. Now, keep in mind, the ones that do go out of business, they're typically not the big A-rated companies that I work with that have been around for a long time. They're typically maybe newer or maybe lower rated or not rated at all. Those are the ones we typically hear that go out of business. So that's really important when you're thinking about safety and you're thinking about getting rid of the risk. Just look at the highest rated companies you can find, as well as make sure they've been around for a while. So if you're doing that, 99.9% of the time, you're going to be just fine. So they're one of the safest investments out there. That's why Warren Buffett invests in these companies, because of their longevity. And that's why annuities have been around for over 500 years, because they are so strong and they're extremely effective for taking that risk off your hands. And one thing I might add, and you'll notice this in one of my other videos, I talk about Babe Ruth. Babe Ruth, he bought a bunch of annuities, and when he did so, the market crashed actually about 7 years after he bought his first annuity, I believe. And he wasn't hurt as far as income. I mean, his income was pretty decent for the rest of his life. And he also had one set up for his wife when he passed away. So celebrities set these up because they know they're not a market whiz. No one is. No one knows what's going to happen in the market. And they know that they need to have some sort of guarantee set up. And so when you do set those kind of things up, you have peace of mind knowing that that income is going to continue for your life as well as your spouse's life. And really, that you can't put a price tag on that. So if you want to chat more, go ahead and book a call. You'll notice that there is a link below this video, and you can go ahead and book a time on my calendar where if you want to chat, maybe look at some annuity options for yourself, I'm happy to go over that. So anyways, thanks for watching. Look forward to seeing you in the next video.